Now let's see some concepts related to taxation. First, progressive taxation. It is a system of taxation based on the ability to pay. Higher the income, more is the tax rate. Tax rate increases as the taxable amount increases. For example, for taxable income of 2.5 lakh to 5 lakhs, the income tax rate is 5%. But as the taxable income increases, the rate of taxation increases. This is known as progressive taxation. Ad valorem. It means the base on which the tax is levied is the value of a particular good or service. For example, GST is an ad valorem tax. So if a t-shirt is priced at 900 rupees, 5% GST is added as a percentage of 900 to the final invoice. Fiscal drag. As we have seen in our inflation videos, high inflation leads to rise in salaries, which in turn leads to a higher tax burden and reduced spending. This increase in inflation causing a higher tax liability is known as a fiscal drag. Thus, in a fiscal drag situation, an individual is left with less money to spend after paying taxes, and additionally, the purchasing power of his money is reduced due to higher inflation. Cess. Cess is levied over and above the base tax liability of a taxpayer. It is raised for a specific purpose. For example, education cess can only be used for investment in the education sector. It is temporary in nature, that is, it is discontinued when the purpose for levying it is fulfilled. Cess levied is initially accrued to the Consolidated Fund of India, and thereafter a dedicated fund is set up for the purpose. It is non-lapsable in nature, that is, if the collected cess is not spent in the current financial year, then it can be used in the next financial year. It is retained by the centre and not shared with the states. Surcharge. Surcharge is levied as a tax on tax. Unlike cess, surcharge is not limited to a specific purpose. It is permanent in nature. Since surcharge is not meant for a specific purpose, it can be changed or removed only when the government feels it necessary. Please note that surcharge is not charged on the total taxable income, but on the base payable tax. Surcharge is retained by the centre and not shared with the states. Tax buoyancy. It refers to the responsiveness of tax revenue to GDP growth. A tax is said to be buoyant if an increase in GDP results in increase in tax revenue without changing the tax rate. Tax elasticity, on the other hand, refers to change in tax revenue with a change in tax rate. Laffer's curve illustrates the relationship between tax rates and tax revenue. Initially, an increase in tax rates results in increased tax revenue. But beyond a point, increased tax rates acts as a disincentive to tax generating activities and thus results in decreased tax revenue. This happens because high tax rates leads to tax evasion, non-disclosure of income, and black money. Thus, Laffer's curve helps in determining the optimum level of taxation.